US stocks fall again. Hey, look, we haven't done a market update in a while. Let's dive into what's going on because the market has changed so much just in the past week, past month even. So we had post-recovery from the recession in 2008, and then we had a pandemic, and that pushed us into living like off planet, like on Mars for 2 years, from 2020 to 2022. It was a extreme seller's market like we've never seen. Houses were getting multiple offers and bidding wars, and the asking price was not just the asking price, it was the starting price, and it was very difficult for buyers. Low interest rates helped fuel that. The great migration that occurred from the pandemic and buyers being retuned to what they need in their homes really just fueled this extreme buyer's market that had the lowest inventory that we've seen in a long time, just from builders doing so little building over the last decade since the recession. And it just was a spiraled effect that created this extreme seller's market. And then it stopped. In June of 2022, just last month, the Fed really pushed to fight inflation, which inflation was caused by a number of issues, but notably because of the supply chain issues that were caused by the pandemics and the buying power and all the money that we saved up, and all that kind of spiraled into this huge inflation. And inflation was considered the number one threat to the economy. And the Fed's response to it was to raise interest rates. And that was after low interest rates started the year. I mean, in January, we had rates just around 3%. Now they're up to nearly 6% when we started June. And that number is a huge cost to buyers, particularly, like, say you're a buyer that was in a $300,000 purchase range. If your monthly payment was $1,400 in January, that would be reduced to like $260 today at today's interest rates. You lost like 25% of your entire buying power just by the interest rates, all else equal. So that has a huge effect, and it really put a cool on the market. And that was the Fed's goal. And then last week, we saw the numbers in the stocks really getting excited because it looked like the Fed wasn't going to raise the rates, maybe not as much as they had said they would in July. And so we saw the largest decrease in interest rates in a single week period in 10 years. And so we went from near 6 all the way down to the low 5s on Friday. And then, as if we couldn't have enough just volatility in this market, Friday ended with a jobs market report. And the job market was 3 times higher than expectations. Companies are still hiring, which shows the economy is still growing, which still shows fears of inflation. So what's next? Well, we're about 5.25 last week in interest rates. By the time we ended the week, post-market trading showed a lot of concerns over the weekend. And so I think what's going to happen is the Fed's probably going to signal sometime mid this week or next week that they are going to go ahead and go forward with that kind of threat that they had in June to do another 3/4 point interest rate hike, which would push us into the 6s again. If they do that, that could help fix the inflation, which arguably I think is starting to get a little towards the top anyways, and it might already be on its way of being fixed. But anyways, they really want to push it down and fix it as fast as they can. So they're going to try to do that, which is going to push us into a bigger buyer's market. And that could also push us into a recession. And what are we going to do if we hit a recession? Well, the Fed's typical MO is to lower the interest rates. So if we hit 6% over the summer, we could be back down to 5 by the end of the year if we hit a recession. So much is going to occur. I don't know what's going to happen, but I do think by the spring next year, we'll see a normal market come back. We're seeing some extremes right now. We went from an extreme seller's market to now suddenly we're in a buyer's market where you can once again negotiate on the asking price. And a lot of that is to do with the rise in interest rates and just the change in buying patterns. But hey, it's also the summer. August and July are the 2 slowest months for buyers in the entire Iowa City market. So it'll be interesting to see what the fall market does. I expect it to be cooled down, particularly from the last 2 years where we're living on Mars, but it's not going to be quite the normal market. I think it's gonna be a little slower than normal market. And then I think by the spring of 2023, I think we'll get back to a normal market. So that's my market update. That's my expectations. That's where I think we're heading. We'll see what the Fed does this month, but it'll be exciting to see.